All right, good Thursday afternoon, traders and investors, and welcome back to our weekly State of the Market. I'm Seth Golden on behalf of Finom Group, and I'll be taking you through some charts, some fundamentals, some technicals, and basically, look at what we have taking place here in the broader indices and possibly a look beneath the surface. So we've had a bit of a correction here at the end of February. We've had some gyrations already here in the month of March. Prices fluctuate, right? Isn't that what George Costanza told Jerry Seinfeld back in the day? But the primary reasons for the correction, in my opinion, are, as I've noted here in the bullet points, rising rates causing some anxiety, some duress with respect to the equity risk premium, valuation concerns in certain sectors. Some of the ones that were overheated in the past have now come under pressure, such as technology. Even to a certain degree, we've seen it in software and semiconductors. The end of earnings season. Well, with the end of earnings season, what's the catalyst to buy here? So, if anything, you see a lot of general profit taking. We have the passing of the fiscal stimulus causing inflation's concerns to heat up that much more because we got analysts and economists estimates, for GDP, for retail sales, and everything in between ratcheting higher on the back of that $1.9 trillion fiscal package. And that's caused some fluctuation in the bond market as well. In my opinion, these are all just transitory factors. It doesn't appear to be anything systemic threatening markets that I can read in the tea leaves. Speaking of investors, there are two kinds of investors. Those who don't know where the market is headed, and those who don't know where the market is headed. That's something that William Bernstein once said. You'll see it professed all the time in social media, though. Here's what the market's doing, and here's what it's going to do. And what I generally say to those people is, why do you care what the market's going to do if you can predict the future? Why aren't you on a beach sipping Mai Tais and margaritas and pina coladas after playing the lottery if you can, predict the future and, you're that prescient? So just know that most people don't know what's going to happen. But at least be honest with yourself. And that'll allow you to be flexible with anything that comes your way in the market. Shelby Davis here. Invest for the long haul. Don't get too greedy and don't get too scared. In other words, don't live on, either end of the extremes when it comes to your investor psychology. Best place to be is always in the middle. Take chunks out of the middle, as I always say, when it comes to, trading. You're not in the business of calling tops or calling bottoms. You want to be in that middle area where you can take a profit here, take a profit there. When you start trying to, bottom call and top call, usually that's when strategies and what have you go awry. The Nasdaq has been all the craze. At least it's gotten most of the media attention over the last several weeks because, well, it got into correction territory recently. A garden variety correction, but a correction nonetheless. The textbooks will tell you from peak to trough, 10%. That's a textbook definition of a correction. One of the things that we've been talking about a lot over the last 12 months, if not 3 years, because in my opinion this does go back 3 years. These markets move fast, faster than they've ever moved before. It's a function or a byproduct, if you will, of a market that lacks liquidity. So we get these very fast moves down. We get these very, quick retracements to the upside as well. So it should serve to figure that this was, like the second or third fastest Nasdaq correction ever. Some of these, here's some of the corrections recently and going all the way back to, it looks like 1986. The more recent ones before the correction that's still underway until we get to a new high in the Nasdaq. Last year, February, took 6 days. 6 days for the Nasdaq to drop 10%. And then in September, even faster at 3 days. The Nasdaq officially moved into correction territory, down more than 12% at its trough from the all-time high this week. It took only 15 trading days to perform the correction. Again, one of the fastest corrections ever. Interestingly, 2020 holds the two other fastest. You have to go all the way back to 1999 to get one of these numbers here. And here we are, 2021 at 15. Fastest 10% corrections for the Nasdaq. Is that good? Is it bad? I mean, that's what we really want to know. What does it portend for the future? Previous fast corrections tend to resolve higher going out 3 to 12 months. Here's the 1 month return. Here's the 1 month return, you know, based on all of these that we saw up here, the fastest corrections. Here's the one right now. That's with all the question marks. We'll find out. Here's two of the more previous ones that we talked about in 2020. 1 month later, the Nasdaq was down 12.4%. That's actually the worst performance. That was the February, of course. But then, you know, the September correction, which took only 3 days. A month later, the Nasdaq was up 4.8%. 3 months later, up 15.4%. We still have to wait on the data for 6 months later, obviously, since this started in September. But if you look at the averages of all these, 1 month later, you're positive just about 67% of the time, a very minuscule return on average, though. But when we extend our time horizons, 3 months later, the Nasdaq is up 6.1% on average, and look at the positivity rate at 75%. 6 months later, gets that much better. Nasdaq average return is 23%. It's up 91% of the time. Better returns 12 months later, still up 91% of the time. The only time we weren't was the dot-com bust. That's it. We got a strong probability of double-digit gains over the next 6 and 12-month period. We're not talking about 10% either, are we? Think long-term, you know, act locally on price. You're getting a correction, you're getting a sale. Act locally, think long-term. This right here, the Nasdaq one-day rate of change was greater than 3.5%. So what am I referring to? Well, recall the sharp bounce in the Nasdaq on Tuesday, right? We had that really sharp reflex action on Tuesday off of Monday's close. On Wednesday, the Nasdaq gave on Wednesday, the Nasdaq gave a 3.5% one-day advance. Now, after the Nasdaq has that kind of one-day move, this is another input. This is just one more data point that we can look at through history. It had a greater than 3.5% one-day rate of change or one-day return. When it does that, 1 week later, here's the returns for the Nasdaq 100. Here's the returns for the S&P 500. It's not good, folks. 1 week later, market is on average down 94% of the time by 1.40. 2 weeks later, it doesn't get any better, and you're still negative. The percentage times your negative is almost 90% again. 3 weeks later, you could be positive, but 69% of the time you're not. 1 month later, so a full month later, still not looking good. 90%, 97% of the time you're down. It's not any better over here either for the S&P 500 after the Nasdaq has a 3.5% gain. Again, this just goes out 1 week, 2 weeks, 3 weeks, and a month. This over here kind of speaks to it as well, so far as corrections are concerned, but depending on what data we look at, we're going to get mixed signals. Having said that, this is just a 1 month. This is 3, 6, and 12 months. Again, thinking long term. The interim could prove choppy, given that we are getting these price fluctuations in the NASDAQ, and we should expect some choppy activity. Having said that, we're not talking about big drawdowns here. We're talking about 1%ers. This is still an area where you should look at, pullbacks in those stocks on your shopping list. as opportunities longer term. All right, here's another chart. Nasdaq 100 index, when volume spike. We've had this really, with this 3.5% move, we had this really big volume spike. You can see volume spike here on that drop back in February, March of 2020. You tend to get these volume spikes when the market falls. So what does it mean when daily volume surges on the Nasdaq, or the Qs, if you will, the ETF, the exchange traded fund? Here's a study from Quantifiable Edges that tells us the 10-day volume to 100-day volume ratio crosses over 2.25 for the first time in a month. Percent change to number of days forward shown in the table below here. So here's how we map it out. On Monday, the QQQ 10 to 100-day volume ratio rose from 2.23 to 2.33. That is a very high level, more than twice the normal, in fact. They look back at all the other times the ratio crossed above 2.25. This is only the sixth time. 1, 2, 3, 4. It happened only 5 previous times, so this was the sixth time it happened. A few things to note. All 5 previous volume spikes occurred with a sell-off over the last 10 days. So did this one, right? We've had a sell-off in the Qs in the Nasdaq over the last 10 days. We had a correction. Fear related to the sell-off is typically what will cause such volume spikes. Again, it speaks to this chart. You see the drop here. You see the volume spikes. Drops here, volume spikes. Drop here, volume spike. Drop here, volume spike, so on and so forth. Let's see. You don't see big spikes in volumes due to rallies, right? Buying is a process, as they say. Why do you think the saying is stocks take the stairs up and the elevator down? Because buying is a process. It takes research. It takes some study. It takes a game plan. It takes entry targets. It's a process. Selling doesn't take much other than emotion. That's it. Most selling occurs based on emotion. So you tend to get volume spikes because everybody's quick to hit the sell trigger. You don't get volume spikes during moves upward because it's a process. Buying is a process. All right, intermediate term returns after this particular signal, the volume spike signal, 21 days, which is basically a month, pretty good, right? Up 1.38%. 2 months, looking good. 3 months, even better, so on and so forth. In keeping with our other, long-term data as well. So interim can be really choppy. Long-term, based on all of these studies, can be pretty darn good for the NASDAQ, for the Qs. All right, what's going to happen next with the NASDAQ? Well, some good things are obviously taking place here today with it up 347 points. It's off of the high of the day, but it's still above 13,400 at the moment. Now, we've seen the NASDAQ drop below its 50-day moving average. It's dropped below its 100-day moving average as well. Look at where we are right now, folks. This is the 50-day moving average in the I don't know what color. I don't see color. That's why I'm not a technician. But you get, we'll call it the gray line here. Here's, that's the 50-day moving average. And we're pretty much right on top of it at this moment. What would be great for the NASDAQ if it closes above it? Is that the end all and be all of the correction if it does close above it? No. Just as well, when we closed below the 50-day moving average here. And here, it wasn't the end of the uptrend. It's a reference point. It's a way station, if you will. However, it is technically bullish if we get back above and close above the 50-day moving average. You could see that kind of technical achievement bring about more bullish sentiment among investors with respect to the NASDAQ. So we'll see if we can accomplish that here on Thursday and going forward. According to this chart, though, if we look at kind of the longer term potential for the Nasdaq as well, assuming it does continue, to seek out, just like the S&P 500, just like the Dow Jones, new all-time highs, based on the Fibonacci extension level, it could get as high as 14,740 in the interim. So that's the 100% Fibonacci extension level up here. But first things first, got to close above the 50-day, got to start heading to that 20-day moving average as well. Chart of the Nasdaq 100 or the QQQ, and it does show you where the, that support might come in, right? We had support. This was resistance back in September, right? Resistance, we chopped around, had some consolidation here, if you will, some consolidation. Then we made another go at it, right? The more times you hit that ceiling, eventually you're going to break through. We broke through, and that's where the real momentum comes. When you break through, just like if we break through and close above the 50-day moving average here today, people start piling on. The fund flows start coming in, and you keep on going. No, we have to pull back. We just broke out. Why do we have to pull back again? So what did we do? Well, we came back here and tested support. Right around 300, if not just below 300 there on the QQQ. So far, it has proven support. We've bounced off that level. QQQs are now touching almost 319. So far, that has proven supportive, and we'll see what happens going forward. Nasdaq after correction, some more data. Looking at the historic data, these are our guideposts. This helps us to level set our expectations. What can we expect out of the Nasdaq after 26 historic corrections? That's what this table will tell us. There have been 26 corrections if we go back to 1971. Looking at the average returns, the downward momentum has tended to continue for another month as the Nasdaq averages a slight loss over the next month, as you can see that right here of 0.12%. This is going all the way back to 1971. It's not about the fastest correction as we saw in the study above. This is all the Nasdaq corrections 10% or greater. The average return from the 3 to 12 months beat the typical returns in the second table below. This is just your, average returns, 1 month, average returns since 1971 for the Nasdaq. This is after corrections. And as you can see, 3 months later, up nicely. 6 months later, even better. 12 months later, need I say more? The positivity, percent positive rate also increases as we go out in time. Now, this one's a little bit different, right? So we're going to throw another element in there, right? Because look at the Nasdaq and look at the Dow over the last several months, right? The Dow keeps hitting new highs. The Dow is clearly just kind of taken off. The Dow doesn't really have too much of a technology component in it, too much of a particular segment of industry that might be sensitive to rising yields. So we can figure that's why the Dow is performing so strong with respect to the ratio of the Nasdaq. So here's the Nasdaq after corrections, but when the Dow is within 6% of its high, which it has been. Like this week, when we started the week, the Dow was within like 0.5% of its high. It has since made new highs. So when it's within 6% of its highs, and after a Nasdaq correction, 1 month later, up 4.06%, a bit different than what we saw over here without considering the Dow, what the Dow's doing. So this is just another input or another variable. 3 months later, 6 months later, 12. This speaks to where you are in an economic cycle, in my opinion, right? Because if the Nasdaq's doing one thing, but the Dow's doing, surging and within 6, it's probably speaking to we've already been in a major correction, and now we're going through the early parts of an expansion cycle, a new expansion cycle, if you will, in the economy, and probably revving up earnings again. We've hit a trough in earnings. It sounds just like what we went through in 2020. So you have this reopening, this expansion cycle trade that is benefiting industrials, materials, chemicals, your Caterpillars, your Boeings, those kinds of big names that are within the Dow. But so when we add that element, pretty strong returns, folks. And look at the positive rate, the percent positive rate, 86, 86, 86, 86. There's got to be one time something must have went wrong. And see what it was. 6 months after correction in which the Dow was within 6% of its high, the Nasdaq gained an average of 26%, with 6 of the 7 returns positive. So, I mean, it's pretty good no matter what, right? I mean, double-digit returns here, 6 months if you consider what the Dow's doing, and double digits here when you don't consider what the Dow is doing, so far as the Nasdaq forward-looking returns. But it does help you to differentiate, are you in the latter innings of an expansion cycle, or are you in the beginning? Because the Dow would tend to do better in the beginning, which tells us we got a lot more gains ahead in the coming years, absent some kind of exogenous event, right? All right, and we've heard all of the nonsense about, yeah, but tech multiples, that's why they're compressing, and they're just too expensive, valuation this, valuation that. And as we've highlighted many times before, unlike the dot-com bubble, tech company profits are more in line with prices. Look how out of whack it is here. And we're pretty much on par over here. Information technology sector as a percent of total market capitalization of the S&P 500 is in the light line. Information technology sector as a percent of total profits is almost touching. Easier table to rectify the whole valuation concern. If we go back to 1999, right, just before the dot-com bubble burst, the information technology sector as a percent of the S&P was 29%. In 2020, it was 28%. It's down below 27% right now, folks, because what we've seen in financials have started to take market cap away from technology for the whole of the S&P 500. What's most important, though, is the EPS. What is the contribution from information technology sector to the percentage of S&P 500 profits or earnings? Back in 1999, it was 12%. In 2020, it was more than double that. We're not talking about the same we're not talking about your father's information technology sector here, folks. We're not talking about dot-com issues. This is a very different and highly profitable segment of the S&P 500. You got to go with that. All right. And we talked about the Dow Jones, and the Dow Jones transports within, if you're thinking about FedEx, if you're thinking about Boeing, certain of the Dow Jones transports. Actually, I don't think Boeing is a Dow Jones transport. Nonetheless, what is signified in the Dow Jones transports, or the DJT, they hit all-time highs. They continue. Look at this, folks. They just continue to move higher. This is predicated upon the reopening of the economy. We're going to have more products being shipped. We're going to have more e-commerce sales. We're going to have more airline traffic. People are going to get on planes again. People are going to get on cruise lines again. People are going to be renting cars again, going on vacations. That's what's being priced in here by the Dow Jones transports. Priced in. Remember, the market is a forward discounting mechanism. People keep saying that, well, tech is lagging and we expect it to lag going forward. It's a new cycle. We think financials will lead, maybe value over growth. and I've been I look at it a different way. I don't want to say I disagree or I agree. I just look at it differently. In my opinion, tech is leading. It's still leading. What did I just say about the Dow Jones transports? What do we know about the market? The market prices, discounts future earnings. Well, technology already discounted future earnings from basically the bottom, in March through about September. It's already discounted it. Now it's leading the next stage, which is price consolidation, a little bit of multiple consolidation along with it before its next leg up. The only way that's a inappropriate or maybe even incorrect thesis is if you believe small caps, value, financials, Dow Jones transports will not correct. They're just going to keep going up. Does that make sense? All right, we're all on the same page here. Okay. Here's another way, speaking of technology and how the Nasdaq is underperforming even the Dow, and technology is underperforming financials. Technology is underperforming energy. Energy and financials are like the worst two sectors in the market over the last decade plus. But here's a chart that looks at the relative ratio performance of tech versus energy. Back here was the dot-com era. And you can see tech, was stronger than energy up to this point and then fell apart, right? But then we got back down here in 2009 and tech regained leadership from 2009 all the way into and through most of 2020. Now we're coming back down to this long-term, what used to be resistance is now support. We bounced off of it once already here, folks. Will we bounce off it again? I'm of the opinion we will. I don't see energy, leading the next expansion cycle. I don't see energy leading the next bull, the cyclical bull market either. Investors go where free cash flow and earnings are. And it's just a matter of that becoming realized. So we're at this kind of support level that we saw recently here in 2020 and going all the way back to the dot-com era. Really cool chart from Thrasher Analytics, in my opinion. And also, I think this does, based on the chart formation, sets up a potential mean reversion favoring tech if the ratio can hold above this 2.37 level. We'll find out more in the weeks to come. Consumer staples has been one of the dogs here over the last couple of months now. In the market, it was actually the only sector of the S&P 500 with a negative return of more than 2% year to date by the end of February. We identified this chart recently that showed that we could be on the cusp of support, a 362-week cycle level support. We also looked at this chart recently as well. This is an Elliott Wave forecast ABC model. And basically, or the extrapolation here is if we can stay above 63.94, we should expect higher prices for consumer staples sector and possibly the individual consumer staples stocks. So if we look at remember, this is the number, 63.94, price of the XLP consumer staples. Let's see, there we go. Strong tape, right? People aren't defensive today. They're not defensive. They're going out and buying cyclicals. They're buying tech today as well. So it should be under pressure. We would expect it to be, but it is above the level we noted, 63.94. It did briefly get below that level, but has since gotten back into a better area. I wouldn't expect consumer staples to have some kind of breakout, but given that we have rebounded nicely over the last week or two, the consumer staples sector was positive last week. We've seen Pepsi find a floor below 128 recently. We've seen Walmart also find a floor just below 127, bouncing up to 133 today. And Costco, ever since earnings, has actually been moving higher. It got down to, I think, 307. These are some of the biggest names in the consumer staple ETF, along with Procter and Gamble, which got below 125 and has since bounced over the last week or so. So a lot of these individual names within the consumer staple ETF have seemingly found a floor. We may have the same situation. If we look at, a 2-year chart here of the XLP, we can see a clear base here being formed. Consumer staples did well in the last, cycle in 2019. And they actually did well coming out of the bottom. People were still kind of defensive. They were uncertain of how things were going to play out. Made a new high here, but since then we've done a lot of consolidation. This is a nice head and shoulders. Well, it's not pretty, but it's a head and shoulders pattern nonetheless. You got your right shoulder over here. This is the bottom or the neckline. And you got your left shoulder over here. The left shoulder as of right now is higher than the right shoulder, which is also a good sign. What we want to do is get back above, a close above this peak here in the right shoulder. That may create some momentum as well. All right, so 1,000 on the S&P 500, 2,000, 3,000, 4,000 has been a tough slog, right? That seems to be the case for each 1,000-point achievement in the S&P 500. We looked at these charts in the past as well, signifying each turning point above, 1,000 or so in the S&P 500. This one goes back to, it looks like 1997, 1998. And we chopped around. We tried to get above 1,000 here, couldn't, consolidated. Tried to get here, couldn't. We had another correction. And it wasn't until 1998, boom. And when we did, we took off, folks. So that was getting above 1,000. Here's getting above 2,000. And that happened, it looks like 2014. Got close, a little bit of a correction. We finally got there, but we also had yet another consolidation period of 8.6%. And then we took off nicely. Did a lot of sideways action here into mid-2015. We had a pretty decent correction into 2016 and then took off. So there's a lot of hesitation in and around these 1,000-point levels in the S&P 500. Here was 3,000 in 2019, as you can see here. Well, we tried to get to it at this point in early 2019, had about a 13% correction. We got back to it, and it looks like August, June, July, August timeframe, and then we had another correction there. Off to the races once we cleared that level again, though, into 2020. So it should be no surprise that we're seeing hesitancy, we're seeing consolidation. But if we do, tag that 4,000, it's very probable that we could get some lift off. And that's even before we start talking about all the fiscal this and monetary that and liquidity and consumer spending and checks going out and stimulus. And so strap in and have that shopping list, as I always say. Equal weight S&P 500 is a different story. The equal weight S&P 500 has been hitting new highs all week. It tells you that there's a lot of stocks that are participating in this up move. They are validating what the overall market is doing. However, and as you can see from these arrows here, the RSI for the equal weight S&P 500, the RSI has diverged. It's a bearish divergence. We are making new highs, but on less momentum. And in my opinion, that's a factor of small caps and mid caps just getting kind of exhausted. And also one of the reasons why I think when they start to correct, the large caps are going to come back in favor. What do we need to get the S&P 500 to new all-times? We need participation from the large caps, and they haven't been participating for weeks on end now in 2020 21. Today, this week, we've actually gotten good participation out of the large caps. You have Microsoft moving higher. You have Amazon moving higher. You have Apple moving higher. You have Facebook moving higher. Your large caps, your McDonald's moving higher. Your Walmart's moving higher. These stocks have to come to the party, okay? But the equal weight speaks to strong market breadth, but weakness amongst the large caps has taken place. This week, we're getting some participation. One of the things we say when it comes to the equal weight, we like to see the equal weight doing well because it, again, validates where we should be heading longer term. As it pertains to the cap-weighted S&P 500, the generals might be struggling. But the depth of the army, right? The equal weights, that's the depth of the S&P 500. That's the army, the small caps and the mid caps. They're not weak. It's far more worrisome when the generals are advancing without the depth of the troops. You want your army behind you. You don't want large caps being the only thing propping up the market. To the extent that that's what we heard, you know, coming out of the trough in March, April, May, well, it's only FANG, it's only a handful of stocks pulling the market higher. That's true. But then everything else followed. Everything else followed. The troops are, you know, with the market. We talked about this just this morning in the trading room with our Finom group members. This is the S&P 500 advanced decline line. It hit a new high yesterday on Wednesday. You can see that right there. Breadth to date, and we know this about breadth leads price. So if you have good breadth, it tends to lead price in the not too distant future. It tends to also, if you hit a new all-time high on the advanced decline lines, you tend to see new all-time highs in price at the index level in the not too distant future. Did I know it was going to be today? No, of course not. It could be weeks. It could even be a couple months. It just depends on what's going on in the macro market picture. But this is another way to confirm you should see new highs in the not too distant future. Now, the chart that we looked at in the trading room this morning was the NYSE composite stocks, the percentage of NYSE stocks at 52-week highs. Look at how, I mean, this is the best we've seen, you know, over the last 6 months or so. Again, signaling that breadth is strong. This is not just based on a few stocks. This tells you that we should see continued market strength absent some kind of exogenous event. It does not exonerate corrections. It does not tell you the magnitude of consolidation or corrections either. But it does tell you what you should be doing when you get stocks on sale. You should be buying the dip. Have a game plan. Which distribution would you rather? This chart is awesome. This is from Renaissance Macro. We've talked about this many times. People get scared. Oh, I don't want to buy at all-time highs. I'll wait for a pullback. I'm sorry, the best time to buy stocks is it when they're at their all-time highs. I'm speaking at the index level, of course. 3-month returns after 52-week highs are greater than 20%. This is where you want to be. This is just standard 3-month return distribution over time. But when you're at all-time highs, the percentage gains are that much better. New highs beget new highs beget more fund flows. It feeds on itself. All right. It does seem unnatural because all you hear is I want to get, and it's social media driven. I'll wait for a pullback. I'll wait for a pullback. I'll wait for a pullback. The reality is when the pullback does come, people tend to sit on their hands. They feel, it'll drop some more. I'm going to wait to see if there's any more downside before I actually pull the trigger. Just have a game plan. And speaking of game plans, we've been feasting, if you will, on the Nasdaq's pullback, on the QQQ pullback. the game plan that we talked about at the end of February in our February weekly research report. I am currently building position in individual stock names like Apple, Pepsi, and we'll look at some leverage ETFs like TQQQ and potentially SSO in the very near future for the Golden Capital portfolio. With that said, let's look at our final weekly study. This was our game plan that we outlined in our weekly research report to Finom Group members, and we've been executing it like a beast. We've had 12 trade alerts, official trade alerts to our Finom Group premium and mastermind option members over the last 2 weeks. And we've been using these scalp and swing trades to develop a core position, which is now cost average at about $68, $69. And when you look at TQQ, after all these profitable scalps, it's at 91 and change. Yeah, it moves fast, so it can certainly come back down. But longer term, as I said before, I think tech is leading still. It's just leading a different segment or a different period of this cyclical bull market, this newer cyclical bull market. All right, with that being said, we'll talk a little bit about bonds now. We can kind of move past, technology and the Nasdaq. This is a chart of the TLT, the bond ETF, the 20-year bond ETF. Look at this right here, folks. The 14-day relative strength index of the TLT bond ETF. It's nearing a record low in the RSI. Right, so as bonds are being sold, and we see treasuries yields go higher, but bond prices go down, the bond ETF gets weaker, and the RSI is basically saying, you can't get much weaker than this. Any more than the 10-year has said, I think we're topped out, the 10-year yield at 1.62% for the interim, not for always, but for the interim. So this kind of coincides with it. The bond ETF relative strength index is saying we're probably at a low here. Bond yields are actually more attractive now. They should see some kind of natural demand side come into the equation and provide some support and some downside pressure on yields. This chart right here is the TNX. Very similar. You can see the yield going higher. TNX is a ticker symbol for the 10-year yield. Yield has been going higher, but the RSI has not made new highs. So another bearish divergence, if you will, again leading us to believe that I think the 10-year yield has topped out. The TLT bond ETF has probably bottomed out. We'll probably see some buying of bonds in the not too distant future. I wouldn't expect it to be robust, but it is what it is. The largest year-to-date drawdowns in 15 plus years for treasuries. Here we are in 2021. So they've been selling bonds hand over fist, folks. Largest drawdown in 15 years. Here's another analog looking at the TLT, the bond ETF. Historical periods with greater than 50% and top 10 correlations. So we've seen this, kind of action in the past. Here's a study that also tells us we're probably at a bottom and we should see a lot more green over the next week, 2 weeks, 1 month, and 2 months within the TLT bond ETF. Look at the positive percent rate, folks. 99%, 78% 2 weeks out, 100% a month, 2 months later, 98%. There's got to be an appetite out there somewhere, and I think we're pretty close to it when it comes to bonds. All right, folks, well, that's all I've got for this week's State of the Market. Thank you for tuning in. If you enjoy and appreciate our content, please hit the like button or subscribe button on YouTube, and we'll see you next week.